And I am live. Good morning, everybody. Mic check, mic check. So sorry for the delay. I am literally juggling, um, I guess, a lot. I'm just going to give this about 30 seconds to a minute. I'll start in exactly a minute. A lot of people expect me to start at 9, so they might have given up on your boy today. And I completely understand. I just want to make sure this is put across all the socials, and then we shall start, right? But if you're in the room already, just please help me with a quick mic check. Am I coming out loud and clear to you on your side? It's absolutely
Ready? Just
important.
please help me with a quick mic check. Am I coming out loud and clear to you on your
There we go. So I got the feedback there. I'm just quickly sharing this, guys, to our public Telegram group, and then I start, right? So please do bear with me. But while we wait for anyone who is around, we're gonna be doing a war room today. At the center of this war room today, I'll be looking at the Fed rate hike today. Thank you, guys. Thank you so much, Alan Bongi. Thank you for being here. Thanks for the mic check. Right, we'll be looking at a couple of things in the markets. We'll be looking at what I think is going to happen. I will do a little bit of teaching today, not about how to trade or market structure, what. But I want you to understand the Fed, bits and pieces of the Fed. And it's just how it is, man. You know, generally speaking, when I am free, I try to find more things to learn. I'm constantly trying to better my game, fundamentally because I'm extremely passionate about this stuff, but also because when you're dealing with something as big as the financial markets that regulate the way thousands, if not millions, of humans think, you really want to understand this stuff. So you'll learn a bit more today. Those of you who are around, I believe in the power of one. So whoever is on the live, let's get started, right? So I have sent this out to the public Telegram group. I know it's during the week. I know it's a terrible time in the mornings to have a full blown war room, but I wasn't around this past Sunday. I do apologize. But for the most part, I hope that today will be, of good use to you. If you can watch this before 8 p.m. tonight, that would also help a lot, especially around the Fed. You can see there's a big countdown there. We are, 10 hours into the Fed hike. If I am free at 8 p.m., I might actually stream the actual Fed talk on our 365 page. And if I stream it live, it would also mean, I'll be pausing and making my own commentary to explain things, but I can't really promise that right now off the bat, but it might be a good thing to do. You really need to almost get into the habit of wanting to understand these people, because that's how you make your money. Like if you're a trader, this is it. This is it. This is your business. These are the people going to be making decisions today that affect, financial markets in the long run, right? So I've got a lot of things to talk about, but maybe perhaps it's worth just noting a couple of things, just having a look at how we kind of like perceive the markets. There won't be time for me to do both a big war room and our London session stuff. Yesterday's video, guys, believe you me, I hope it was as basic and as simple as I tried it to make. But for intraday traders, that's generally what you want to be very good at. For intraday traders, you really want to go back and watch yesterday's morning live session. The one thing that I didn't add, or that I forgot to say, or ran out of time to say rather, was the fact that when it comes to stop loss placement, after you found your areas of value on the 15 minutes chart, you always want to scale back down to the 5 minutes chart, because there's 9 out of 10 times there's a level on top of a level, or a level under a level. So a 5 minute supply on top of a 5 minute supply. And you want to make sure that your stop loss is outside the very top supply. All right, so that's going to be important. Why can't I connect to Forex Factory? That is very weird and awkward. Right. So today is a big day in the markets. I think every day is a big day in the markets, but today specifically is a big day in the markets. A lot of things have changed from our predictions of where we thought price would be today. In fact, I'm no longer even holding our long-term dollar trades, right? Which is such a pity, because I bought into the dollar at the last big interest rate, right, which was sometime on the 16th of June, 2021. And if you know my trading strategy, you'll know that I align myself with the banks. So I look at the 3 month strategy, in the 1 year take profit target, in the 10 year plan, and I truly believed I was going to exit my buy positions on the DXY sometime in June. But lo and behold, we arrived at a monthly contact. This uptrend, by the way, is still very much intact. All right. This is where we bought. Those of you who bought with me, I don't know who bought out where. We bought once here, I bought again, and I've got again. And then ever since then, I've just been trail stopping this thing, covering this almost every Sunday from June last year till, about 2 weeks ago. But unfortunately, or fortunately for me, it depends how you see it. When markets hit a governing supply, I exited. I've told you guys many times, just like Euro USD, all right, just like Euro USD, markets want to get to point C. We're going to make this point C. Markets right now are in touch with point B, coming from point A. Point A is obviously all the way down there on the 16th of June, where price was from, right? The same, what I'm saying is exactly the same for Euro USD, just the reverse. Euro USD has made contact with a demand, right? DXY has made contact with the supply. Markets need to get to point C. The only way how, markets don't move around things. That takes forever. Institutional level must be taken out by institutional opposing level. So the only way to point C is through B. Markets have to remove this. So there are ways I can look at this. Number one, Leroy, you could have held on, right, and seen that through. Okay, and that's true. But the problem is, I simply trade supply and demand. So when the governor changes hands, I don't ever assume I am Neo or Morpheus or the Oracle or your prophet at your church to know the future. I automatically assume when markets arrive at a significant governing areas, are significant areas of control, I get out. I could have scaled in and out. I've taken about two small intraday time frame positions that have paid very well. This in front of you here was one of our previous signals in the London session. This was 1:, I think 41 risk to reward. There is just behind this red stuff there. I'm gonna to make it a bit big, but it's literally, see, 31 somewhere there, because my stop loss was just covering. Or maybe let's do this. So I really want you to see it there. Covering this gap, the demand was down below as explained. This was close to 1:40, a beautiful 1:40 on the eight. So I've been taking trades like that on the dollar, waiting for a perfect entry to continue forward. But I am not a fundamentals trader. And by that, I mean I don't wait to anticipate the news and make trades during volatility moments. I wait to get the data, which is what I'm going to be talking to you guys about today, and then make sense of it so that I have good moves. Because if I look at this chart properly, there is still a lot of potential for me to come back into the markets on the dollar for a long-term swing, or at least a swing up until June. But it is all dependent on what the FOMC is going to say today. It is very much the FOMC's market today. And the whole world is listening with a lot of anxiety in the next 10 hours. So if you don't mind, that's the kind of stuff I want to cover in today's war room. Number one. Number two, I want to just look and scan through the markets. I don't know how far we'll get, but we're going to try and look at a lot of assets. I think it'll be wise to prioritize a lot of dollar assets first. All right. It'll be wise to see where markets are right now, and then to slowly try and make sense of the fragment, like with where's money going, etc., etc. But if I was a patient person, which I believe I am, thanks to the stubborn nature of my loving partner, it's taught me how to be extremely patient. She's right next to me. That's why I'm talking so snacks. Right. I'm willing to bet that price can come here. I'm willing to bet that somewhere in here is a good demand that intersects with this trend line. And somewhere in here might be a perfect long-term buying opportunity. I love buying the dollar because if I have a good long-term dollar trade, I am forced to keep completely up to date with the markets. It's to manage my own account, but just to understand the heartbeat of the markets. So this is a good level that I'm looking at here, 96,330. I can't tell you if markets are going to come here today. I don't think they will. I can tell you that this is a really good place for markets to bounce back and then continue to the upside. That I can absolutely guarantee. But it's all based on the FOMC, right? So before I start running around, today like a headless chicken, I think it's best for us to kind of like just quickly pick up the pieces where they are. Right now, is this working? This is not working. How unfortunate, because I actually genuinely wanted to see where else can I get news. Let's go to investing.com. Maybe we'll be lucky there. I really wanted to see what happened last week Thursday. Believe you me, I still haven't. I literally still haven't had a chance to I haven't used this website in a long time for what I want to do. Economic calendar. There we go. I haven't checked. I mean, I'm pretty sure Tesla stops work at China. Oh goodness gracious! Tesla is now in war in China, right? I haven't really taken the time to really sit down and really assess what happened last week, which is all the stuff I missed. This economic calendar is such a mess. Just please bear with me. Please bear with me. Yesterday, next week, right? Let's go here. I just want to see what happened on Thursday, because I think a lot of that is going to be hanging over the FOMC's decision today. So this is, there we go. Today is the 16th, Wednesday. So last week Thursday is here the 10th. It's from the 10th. My systems are sluggish. It's the first time I'm powering this system up since. Well, I actually didn't switch it off, so maybe that's the problem. Been working on my work desk a lot. Right, so we've got Thursday, guys. I can't even make sense of this economic calendar. I'm so used to Forex Factory, so I think I'm gonna. And there's so many silly ads here. I think I'm gonna let this go. But if anyone could someone do me a favor? If you've got access to Forex Factory, could you please go check what happened last week to CPI in the live? I mean, I know it's weird that the guy hosting the class is asking someone else to do a runaround, but I'll honestly, absolutely appreciate that, because for some reason my Forex Factory gate is closed for now. So you've got other means. I mean, I could do it on my phone, but I think I'd be very distracted while talking here. Right. But this is the first thing that I want us to look into today. Right. The Fed monitoring tool. The Fed rate monitoring tool is found on investing.com. And we spoke a little bit about this last time. We spoke, I showed you where it is, I showed you what it means. If those of you remember, the speculation about a month ago, right, was that there was going to be an almost 67, 65, high 70% chance that the Fed today was going to increase the interest rate hike to about 0.50 basis point. You can see over the last 4 weeks from the last war room that I showed that to you, that over time this has completely dropped. And the reason why this has dropped is because of the war, right? It's because of the war. The war has really had a thorough impact, right, on how market makers perceive things, how we plan our economies, growth, GDP, all sorts of things. And so now everybody really, when we go 97%, I'm talking market participants, hedge funds, financial analysts, Yahoo Finance.com, Bloomberg, most big financial analysts are stuck on, well, there's 100, very close to 100% chance that for sure today we are going to get a 0.25%, type of basis point rate hike. That's the normal stuff. Okay, so it must be done. Thank you so much for trying. I appreciate that. Thank you so much for trying on Forex Factory. I thought maybe it was me. All right, cool. No, that's perfectly fine, right? Well, we know CPI region was high anyways, right? So I just wanted to see how high, because I taught you guys last week to watch out for the trap. They killed the wages on NFP the other week, and so they were going to do something similar with CPI. We wanted to see if they're going to lie to us or give us the real data, right? So this is interesting. So rule number one, tomorrow, sometime tonight, because 8 p.m. in America is about 11 a.m. in America, 8 p.m. in South Africa, 11 a.m. in America. So there'll be a lot of headlines while we go to sleep tonight. If you're in South Africa or Africa, watching this channel, wherever you are, a lot of headlines that we're going to all wake up to tomorrow. And what those headlines do is bait shopping for retail traders. Do not buy into that. If the Fed Right. And everybody, by the way, is expecting the Fed to do this. If the Fed tonight, sorry, at 8 p.m., increases the interest rate hike by what is this? By 25% basis point, right? Then it would not be surprising. Do not be surprised if you get headlines that say back to the moon. Fed does 25% interest rate hike after so many years. Finally, markets are hawkish. Finally, blah, blah, blah. It's nonsense, right? There's no finally here because it is expected. If something is expected in the markets, it's already priced in. The volatility, the movement, the jump, the drops are already priced in. Markets won't care. It's already anything outside of 0.25% basis point rate hike today is what is going to freak the markets out. Everything else is now consensual, right? Markets have agreed to 0.25. Markets will not be shocked by that. Markets have already started pricing that in. Look at your dollar. It's not dropping like it's hot, even though it's sitting at the gates of a governing supply. It only fell for 2 days and has fully recovered and is now making its way up. These are PCP patterns. You don't have a new daily supply being formed on the left, right? So markets have priced in the fact that the Fed is kind of like awake but slow. Now, I want to teach this for 15 minutes, maybe 10 minutes, and then we look at charts. And I want to introduce to you guys what I've enjoyed this year is outside of a course framework. I keep adding stuff to you guys, right? So look at this document, and I don't want you to be freaked out. I don't want you to be freaked out. I don't want you to be freaked out. It's just a document. Everything that I'm teaching you is not hard. It's just new. It's not hard. It's new. It's not hard. It's new. You don't have to sit through this type of stuff. I would encourage it, right? I don't want to be the only guru, and not that I am a guru, but I don't want to be the only person who knows stuff. So that's why I'm teaching you the stuff, all right? This is what we call a summary of economic projections. This is my job. If I run a trading floor, I want my traders to focus on trading. I have to focus on trading, but I also have to focus on the direction my floor traders are trading in. This is a broad look into one of my fundamental strategies. I keep in touch with stuff. I know what I know because I keep in touch with stuff, right? Warren Buffett reads 500 pages a day. He's not reading comics, right? He's keeping in touch with some stuff. Now, check this out. This is very important. This was last year, December 2021. Right. Now, why is this document important? Well, because this document is compiled by the FOMC. We know about Powell. Powell is the Reserve Bank guy. I use the term Reserve Bank because it's much more natural in our African context. In Africa, we have reserve banks. We have a Reserve Bank governor. In America, they have the FOMC, Federal Open Market Committee. There are about 9 of them or 8 of them, I forget. These guys vote. It's a voting system. Powell doesn't have all the power. The vote is quite simple. Out of 8 or 9, however many they are, I forget sometimes, they have to all contribute their market speculations. The Fed, ladies and gentlemen, like your reserve governor in your country, South Africa, Zimbabwe, Botswana, Kenya, doesn't matter, has generally 2 jobs. 2 jobs. Number 1, make sure the economy gives us maximum employment. It's a pity Forex factory is down because I was going to run and show you NFP. Right, you know that NFP was massively bullish. You know that the previous month when ADP said it was going to be negative, NFP was massively bullish again. This is the Fed's mandate. When the president appoints the Fed and says, look, man, I want you to do your job, employ our people. They want employment, not just employment. They have a term for it. It's called maximum employment. If I ever taught you at Rhodes University, I know there are some 365 traders from Rhodes University, and I was teaching you guys in second year in industrial economic sociology. We looked at an economic model called Keynesianism, which is social capitalist democracy, which really expands on the fact that the state can interfere in the free markets to create maximum employment. In the time of World War, you just put lots of people into war. Soldiers. What are you doing? You're employing them. But now This is now reserved to an economic branch, the FOMC, maximum employment. Number two, the second job of the Fed, number two, is control. I'm going to write C. I can't, it takes forever to type properly with this little pen here. Control of price. So I'm going to pull this CP. Control pricing in our economy. If a loaf of bread is $10, keep it at $10. If a loaf of bread is $10 and it needs to go up because of inflation, because of the cost of products in our society, make sure that it doesn't just move from $10 to $12. That's too big. Make sure it first goes to $10.20, $10.50. This is the job of the Fed. This is Powell's job. Powell terms run, I think, 8 years at a time, which means presidents who can only run for 4 years and have to get re-elected, right? I think actually I'm lying, about 14 years, 14 years, 14 years, Powell's term. You'll Google and just double check. It's longer than the president. So Obama had 2 terms. He was in 2008 and I think later on in 2000, whatever, 12, just before Trump. That was 8 years that Obama had. Powell was there. Powell remained after Obama left, and then Trump came in. Powell was there. Trump is gone. Biden is in. Powell just got elected for another term. That's the importance of this office. This office precedes the extent of the president because the economic lifeline of a country is important, right? So that's my introduction of why this is important. Now, this document, Summary of Economic Projections, happens every financial quarter, 3 months, all right? And it's an important one because every single member of the FOMC has to cast their votes of their projections of where the economy is going. Now, some people are hawkish, which means they always want the interest rate to go up. They hawkish, like a hawk means go up. But some of them are very conservative. They are dovish. The final decision for interest rate hike boils down to voting systems based on everything we've been talking about every Sunday about interest rate and all that kind of stuff. The latest document of the Fed rate hike is this one. It was last done last year, December. And it is interesting because today, since yesterday, the Fed meeting is 2 days. Since yesterday, we have been slowly but surely starting to compile a new summary of economic projections. So for 2 minutes, I want you to look at this because if no one ever teaches it to you, you'll never know. You'll absolutely never know. I want you to see why this affects your trading. It's not something that you always need to go back to, but I think it's just worth knowing, right? There's no harm in knowing the stuff. Right, now, I'm not going to waste my time breaking a lot of things down here, right? I can do this for 4 to 5 to 6 hours. But number one, we're using a median. Median is better than average. Median is more sensitive. Median means if the numbers come off a little bit off, things are going to change. This is what I want us to see. I think remember this was done in December last year. I think this is going to change a little bit, but it doesn't matter. This is the gross domestic product. I think it's going to go down to 3%. Why? Because of the war. I'm thinking FOMC is going to be like, look, we're already at supply chain problems. Things were bad before the war because of COVID. Now, because of that, we really should consider expecting a 1% drop. And that's fine for an economy. What you don't want to see, what you and I will come back to this document when the new document is released after the FOMC. I will come back and tell you what has happened, because if they change anything, I need to take note and you need to take note. When this changes to something like 1%, we are in trouble. Recession, that recession thing that I've been talking about, right? Now, the FOMC is going to be careful. The FOMC does not care about your take profit on NASDAQ, doesn't care about your Forex trades. What the FOMC cares about really is maintaining a gradual decrease in the markets. The FOMC does not care that NASDAQ hasn't hit an all-time high this year, that NASDAQ is at about 13,000 US dollars and its all-time high was almost close to 16,000 US dollars, and therefore we need to do something to give it a new all-time high. That's not the FOMC's mandate. The FOMC likes when markets gradually, not all of a sudden, but gradually come down. That's important for the FOMC, because if the markets gradually, once in a while, have massive retracements, if the markets, let's just quickly pop, let's go to NASDAQ real quick. If the markets gradually keep coming down every now and again, it pushes risk aside. What does this mean? It de-risks the market. When you de-risk the market, you avoid a crash. When you have a crash, things are screwed for everybody, for the FOMC, for the economy, for the stocks. What do the stocks represent? They represent companies, which means companies are not doing well. When companies are not doing well, what does that affect? It affects two things: the FOMC's mandate. Number one, the control of price. Number two, maximum employment. When these top 100 companies in the NASDAQ underperform, in a crash, not in a retracement, but in a crash, right? In a financial crash, then they'll stop employing people. Then prices need to start going up. So this gradual decline, this was more of a sharp decline, but gradual nonetheless, since we've got ups and downs, is not yet a problem for the FOMC. The FOMC is not showing up today to protect the NASDAQ or to protect the stock market. They are okay with a gradual decline. They just don't want to surprise the market with a big crash, because that's bad. All right. So GDP, whether it's important to you or not, I'm just letting you know that my expectation is for this to adjust a bit and to drop. What's interesting is in December last year, now listen to this. Remember, this is December 2021, right? Just before everyone closes for Christmas. They said their expectation for employment, for the unemployment rate, right, in the markets is 3.5% for the year 2022. They only want 3.5% of their population to be unemployed. In 2023, 3.5%. You see this? This means this is the Fed's definition of maximum employment. In South Africa right now, we have a 40% unemployment rate, slightly higher. It just depends who you ask. Don't ask the government. They'll lie to you and give you a number like 20-something percent because of how they calculate it. The real number in South Africa is maximally around about 40-something, 42, 43% unemployment rate. In America right now, they are moving towards maintaining this. This is good. Now, if you just go to Google and you just type unemployment rate in America, this is based off because you guys trade NFP, but I really wonder, do you really know what it is that you're trading, right? The unemployment rate in America right now, where was it? I saw it. It was 3.8%. I literally Googled this earlier on today before this. So those are just so 3.5% unemployment rate was this, blah, 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 blah. All right, well, I don't want to open the statistics of Bureau. But anyways, if you check your NFP data, it's there on Forex Factors, about 3.8%. I mean, that's what we got, this previous NFP. It'll just take us forever to find it here. It'll take us forever. But yeah, if you go through NFP, the last NFP results is right there. There was 400 and something jobs created, and unemployment dropped to about 3.8%. Which means the Fed is on track. It's just that I don't like saying things and not showing them, and then I'm like, just trust me. You need to see this stuff for yourself. So I'm gonna go 3.8. There we go. The total, you guys can see this now. The total a non-farm roll in February this year, 2022, rose. So 678 jobs, blah, blah, blah. Unemployment rate edged down to 3.8% in the US, right? So this is it. Right, I just always I forget where I see this stuff, but it's in my head somewhere. So look at this. They've just done NFP for Feb in March, and they're already down to 3.8%. And their target for the end of the year in 2022 is 3.5. So Fed is done. Fed has won this battle of unemployment. COVID took the jobs, COVID this, COVID that. Trust me, the economy is doing okay. And yes, we have to care about the United States economy because we're Forex traders trading in the global market, all right? The South African market isn't making global waves. That's why we're focused on US news. Right now, it's not that I'm an African. It doesn't affect my pockets, right? I have to focus on the thing that moves the money. Now, So unemployment concerns are done. The real issue today, I mean, this is important, but we don't have time. This interest rate hike. So you will notice that for 2022, these guys want to be sitting about 0.09, right? And I think that has definitely changed from the time they made these predictions in December. I'm pretty sure, I have no doubt in my mind, that because of how fast things have moved, because of the supply chains and the inflation and all that kind of stuff, today's vote, if you calculate it, guys, if you calculate 0.25% per basis point, and then you calculate how many meetings we have, right? Let's not even say calculate. Let's do the work. Let's do the work together. How many more meetings do we have between now up until December, the end of the year? You will realize that we're in March. Today we're going to get March, right? So that's May to December. So May, April, June, July, August, September, October, November-ish, right? So we've got about 6 to 7 meetings. So let's say in every single FOMC meeting, let's say 6, number one, they increase the interest rate every single month by 0.25. Remember, Powell said the model we want to use, the 2004 model, where interest rates went up consistently for 2 years, 0.25 for 2 years, from 2004 to 2006. I covered that in one of my previous videos. You see this? This puts us to about 1.5. All right, 1.5. Right now, by the end of the year, we're at 0.9 interest rate, federal funds rate. And I told you guys many times that Powell is behind. He's in trouble. He knows this. Deep down in his heart, he knows this. But now let's calculate this correctly. January, February, March, April, May, June, July, August, September, October, November. Right. So we've got 8 big meetings. So if everything goes according to book right now, because these guys changed their minds, and there is a systematic increment, we get to big 2. We get to catch up, not catch up, but we're going to get to that 2% mark. Right now, in March the 16th, this is not part of the economic outlook that they had in December. My guess is for today, we're going to see this change. We're going to see the vote change. And my guess is they're going to move this to 1.6. They are going to move this expectation of 2023 and fast track it here. That's my guess, which means we are going to maintain this. I hope I haven't lost anyone yet. We're going to maintain this. What's going to happen though, and what's nice about the Fed tool rate, is every now and again, I find it interesting how the market prices in things. Now, if you look very carefully, this is March. We're at 0.25% for today, for tonight, 97%. And if you go to next month, the ball has changed. People are like, nah, man, the Fed has to catch up. So in May, we might get a much more intense hike rate, a much more aggressive one. Look at June, more aggressive. This is subject to change. But if we scroll all the way finally down to December to figure out where are we, you will see that the majority of the ups and downs, the majority of market participants, smart money, financial analysts, say by December 14 of 2022, the interest rate will be between 1.50 and 1.75, which again allows me to assume that for today's meeting, it's safe to say for now, we will sit here at 1.6. Now, why is this so important, Leroy? Well, because if we get anything outside of this, I want you to understand how to trade it. Because anything outside of this is going to be what we call a rug pull. Anything outside of this is going to be FOMC reading the market and reacting in a different way as quickly as possible because of their own realities. I cannot right now predict what Powell is going to say. Powell's words shift the markets. But I can tell you that if Powell doesn't come to the party and give us the usual 0.25, markets are not going to be happy. The reaction is going to be different. Sure, you could get a dollar rally, but will that happen into a supply? Maybe, I don't know. But definitely the stock markets, which is the equity markets, which is extremely sensitive, which is very much coupled with the crypto market, I've explained this a couple of times, is going to react in an interesting way. Because when markets don't get what they've already priced in, they believe in foul play by the Fed. Now, I've already said It is not a shock to me if the Fed does something that leads to a consistent, systematic, gradual decline in the equities market, which would naturally bring down crypto. That's not shocking to me. These guys don't like bubbles because bubbles lead to crashes, and that's not what they're about. The problem or the difficulty with the FOMC's decision today is the fact that inflation is still very high. And we had a chance to look at our CPI, our PPI, or there's nothing out there in the world that has hinted that inflation is transitory. Inflation is here to stay, and that's no longer debatable. But there's a new, I was talking about this yesterday, and I just want to just brush on it for 30 seconds. There are now two types of inflation, ladies and gentlemen, that you need to be aware of. There's the old one, the one that we need to do tapering for, which was caused by supply chains. Supply chains caused by COVID lockdown. COVID, which introduced printing money. Printing money we called QE, quantitative easing. This inflation is the long-term inflation. This is the dangerous inflation. This is the one that has us at about 7% by the end of the year inflation rate. And the FOMC, I just showed you the numbers, only increasing the rate by at least to about 1, something percent, 1.6% by the end of the year. How is this going to fix that? There's a big gap. So the Fed today is going to tell us if he still believes that by June, inflation will start to do this. And by August, inflation will start to do this. He is the only one who's going to tell us that. Do we believe him? Do markets believe him? Is he talking nonsense? That's a whole different other story. But right now, this is the equation. The second type of inflation has been caused by war. It's a new one. It's what you see this in the headlines, maybe. It's a commodity-based inflation. You also hear the Fed tonight say this. I'm pretty sure. I want to put money on it. It's a live event. He's going to say a one time. If you hear this, please, if I'm not watching or streaming it live, somebody please WhatsApp me or Telegram me or whatever. One-time price shock. If you hear him say this, he's referring to oil. Oil went up because of the war. He's referring to palladium. Big problems there. Palladium shot crazy up. He's referring to wheat. Wheat went up because of the war. Something called bale, which is actually a big part of alcohol. Fun fact: Ukraine produces about 0.2, about 25% of bale, and so does Russia for most of the global alcohol across the world. Thank God I don't drink alcohol. But if you guys do drink alcohol, you better start running some savings because it's about to grow up. So these one-time price shocks, if Powell dare says commodity inflation like oil and all these things that shot up because of the war are one-time price shocks, basically saying, look, they were caused by the war. When the war goes away, markets will regulate. All of the stuff will go away, etc. Be very worried. I would be very worried because Powell did say last year that inflation was transitory, which meant it's just going to go up and come back down. He thought it would never get beyond 3%. Now it's at 7%. It's not transitory. The Fed's job is to downplay things while they make a plan. So be careful of that. Now, all of this being said is to ask you to please watch out. Now, how can we quickly assess this? You're going to have to learn to track S&P 500. S&P 500 represents the annual projections of smart money. S&P 500, the SPY, and I always struggle to find it on TradeView because I don't trade it a lot. XPY or XPX normally. There we go. Nice. Right. So this is it here. This is the sensitive index. Right, what did Warren Buffett say? If you don't know what to do, if you don't know how to invest, simply put your money in the S&P 500 and wait. Why? Because the S&P 500 historically has a good rate of return of 8 to 12% year over year. And Warren Buffett is a long-term investor. So your capital on year one, you reinvest the interest of 8.8% to 12% into the same thing. Next year, you get it again. The third year, you keep reinvesting this in 10 years' time. Boom, $1 million, easy money. That was his whole point about the S&P 500. Granted, I like things like crypto, where you can get 1,000% in a month or whatever. Volatility will come back down. Yeah, we get that. Now, watch out for this. You can watch NASDAQ, you can watch a lot of things, but watch out for how the S&P 500 rotates around the economy, rotates around what the Fed says, because this is their annual target. This really, genuinely speaking, speaks to the health of the economy. If you look at Nasdaq 100 on the governing time frame and you look at S&P 500, you will see the level of volatility. This is big on Nasdaq right now, big on S&P 500, big on the US 30, right? We've got a bearish engulfing pattern. We normally expect price to go down after this in Forex, in most markets. This for us is a big bear sign. We also know that markets in indices. Why? Because indices are strong, religious, buy profile assets that you can get a bearish structure, get a retest, and then beach out in a bear trip. We've seen this happen before, most recently here in COVID, where markets did this. We know that seeing red on the 3 month chart on these big indexes really, most of the time, if I'm not mistaken, represents buy the dip. This was the craziest dip of them all. But that's because markets here were not retracing. This is what a market crash looks like. This is 2008. A lot of us, by us, me, in the institution, believe we might experience a good recession, a real technical change. It won't be because there's a new virus and we're down for 3 months, but in March we'll recover. It will be because, technically speaking, we are screwed left, right, and center. And when we get screwed left, right, and center, even your buy profile assets start to break market structure a little bit and go to the downside. If that happens, then we're definitely coming back to the COVID levels. Now, nobody believes that when I say it right now. I've got the screenshots. I've seen people laugh. You know what I'm saying? People think I'm crazy. It's never going to happen. And that's fine. I'm very much invested in most of these markets. I don't want the markets to crash. I'm not trying to be doom and gloom. I'm simply saying be mindful of this kind of stuff. Be very mindful of this kind of stuff. Right, guys? I don't know if that helped you, but I'd like to start looking at charts right now. I really hope at the basis you get a big picture of what we think. So I think today we're going to get a 0.25. If anything outside of that happens, we are going to see the markets dance in a very interesting, painful way. Some things will go up, flight to safe havens. Stocks might go down. Just because we get a big one like 0.50 doesn't mean it's going to be all the way bullish. Markets will want to know what the hell went wrong. Why is FOMC this aggressive? Because remember, if everyone is saying we want 0.25 today and he gives us more, a bigger interest rate hike, the question is going to be why? You have to watch these live events, man. You have to listen to the questions that the press who represent financial institutions are asking. They are brilliant questions which will open your mind to the stuff. If the Fed goes 0.25, most traders go, yeah, let's just buy. Sorry, 50, because it's strong for the currency. But what does this mean? For the market, this means Powell is scared. He is scared out of his pants of inflation. He thinks inflation is going to be a big monster. And so now he's catching up. Remember what we did with the calculator. Remember, if I go 0.50%, right, in March, and I maintain that aggressive approach. And believe you me, there are FOMC out of the 9, or there's one of them, his name is always there on Forex Factory, who thinks we should go up by 1% and then next month go 2% and then start back down at 0.50 to 0.25. They are very aggressive, hawkish members of the FOMC. But we said earlier on, if they were to get 0.25, right, 0.25 for the next 6 meetings, would get about the what the hell did I type it? Sorry, 0.25 for the next 6 meetings. So if it kept going up 6 times at 0.25, we'll get about 1.5, 1.6, 7 times up until December, which is 8 meetings, right? Would get about the 2%. But if we go 0.50, at least for the first 6 meetings, for example, we're already above 3. Remember, the hawkish members are scared of 7% inflation, which might even end up at 10% by June, July. CPI isn't going to change. Pricing isn't going to change. If more people have been employed, which we can see the Fed is doing a good job of making sure the economy can employ people, those people have jobs, those people are buying things, it's a problem, right? So this
will rock the markets. It will mean that our FOMC is not confident that they have inflation under control. Therefore, don't be surprised if your tech stocks drop. Don't be surprised if your crypto goes down flying, etc., because of the coupling. Don't be surprised if your dollar wants to run a bit, right? We normally call that a Saint Patty's rally, right? St. Patty's Day is tomorrow or something. I don't know if you guys, I went to, my high school was Christian Brothers College. It was actually done by St. Patrick. So we used to celebrate St. Patrick's Day. But it's a green rally for the dollar, right? But for everything else, it's not that much of good news. So be mindful of that stuff. How do you trade this? You wait, get the data, and start to look for setups between tomorrow and the rest of your life. Markets pull back to levels. There is no need for your capital to be in the front line. None whatsoever. I don't understand that. Right. Also, be aware, Powell seems, in my humble opinion, from listening to him talk 2 weeks ago, once might suggest the opposite. He might thoroughly say, because of the war, we have to be dovish. I've explained this in my videos a couple of times. What does this mean? Well, it means the opposite of hawkish because of the war. What if we go into war? What if Biden takes us to war? What if Biden screws up and eventually, I don't even know what's going on in the war, by the way. I'm so out of touch with that world. I don't know if there's peace talks. Maybe I'm talking out of my bum and I'm wrong. I apologize. Maybe the war is over. I have no idea. I've been clean of news feeds, for the last 4 to 5 days, right? I'll get into it now with you. But if Biden is dovish because the war is going to go nuclear, or America is going to go into the war, which means they need money, which means QE is back, what happens is then interest rates can go up. That's the extreme worst case scenario of tonight. Is the Powell's like, look, man, we are screwed because of inflation, but we don't want to make things worse because we've got a war. Now, what happens is, if that's the case, we might have to slow down and see how this will affect our economic growth. So we might just go 0.25, which is what everyone is expecting, which is normal. But if we go 0 today and we go, I know that everyone is expecting us to go up with the interest rate hikes, but after a lot of consideration and consultation with the judiciary and blah, 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 because of the war, we think it is wise to first see where the chips may fall. I don't think that's going to happen. I do know that he is thinking he has no choice but to consider all these options. That's what I know for a fact. I know for a fact that it is impossible to ignore these options. Look at the S&P 500 before I leave this chart, by the way, on the monthly time frame. You ever seen price hang like this on an index? Yeah, sure. Yes, Leroy. Yes, Leroy. You're crazy. It won't come back. It won't come back to COVID levels. This is COVID. It won't come back to COVID levels, right? This is COVID. Yeah, but it could drop some more. Today. What would it take for price to come down there? More war stuff? Markets seem to be bored by war right now. I don't take war lightly. I'm against the war. I'm talking about just market psychology no longer sees everything as end of days in the markets. There's been many recovery days in the Nasdaq and then down days because of sentiment. But for the most part, this is good enough, right? That's a real level. This is the real level, right? Before we get to this crazy COVID down levels, there's still a lot of room for a drop. So just be prepared for that as an investor, as a trader, right? So we can get a crazy dovish FOMC who give us 0% today. We want to see what has already been priced in so that things continue as normal, see some strong confirmations of stability, which is 0.25, or we get a market rug pull where they go, actually, you guys are right the first time, things are bad. Or the 4 dovish members of the FOMC, one of them flips and votes with the hawkish guys, and then boom, we're here, right? It's just a simple vote, right? So it'll be interesting to watch the stuff. I will cover it tomorrow for you as well with the results. It won't be this long. Right now, if you're here and you're still here, I appreciate you. I need to do this quickly with you. We're going to do a sentiment check. Europe markets open ahead. Oh, here's another interesting thing about Europe. Guys, listen to this. I can't make this up. Where's Friday? Check Euro USD on Friday. I wasn't around on Friday. I've explained why. There's no point in going over that stuff. Let's go to our intraday chart on Friday. Let's go to the daily time frame on Friday. You would think I'm making some of this stuff up. right? I want to find the date. Where was the date on Friday? I want to find the date for you on Friday. Last week, Friday was the 10th, 11th. So let's go there. Let's go Thursday, the 10th and 11th. You see here, 8th of March, 9th of March, see these strong bull runs, and then Friday. Why did price go up these 2 days? Yes, price was in a demand, governing demand, monthly demand, weekly demand, blah, blah, blah. I agree with you. But you know what else? Do you know what else happened that no one is really talking about? Or I don't know if you guys saw this. I don't know if you guys noticed this stuff. In the middle of a war, I want to really give you guys some serious perspective. When I say Wall Street woke up today to go make money, I mean that. They don't care about anything else in the world. If there's a war, they're going to make money through the war. In the middle of a war, let's just pretend this is Europe. There's a terrible map of Europe. In the middle of a war, Europe, somewhere in Europe, is what we call our ECB, the Euro Central Bank, which is equal to FOMC in America. ECB is FOMC in America. ECB in the middle of a war. Where is the war, guys? The war is in bloody Europe. ECB, where the war is inside their backyard, where the war is inside. I'm not talking about America. Today, America is going to make interest rate hikes about America, right? About America. And I'm saying a part of Powell I know is a bit dovish. He's not rushing for the 0.50. He's okay with going 0.25. He said that before, but he's not yet ready to be aggressive despite inflation. ECB, despite the fact that there's an entire war last week, Thursday or Friday, Wednesday, just check your headlines, completely tapered, moved to aggressively taper their stimulus. The same people in a war, central bank was like, yeah, we're cutting the extra money. We don't care if there's a war. We're not going to be funding nothing. We're cutting printing money. We are moving more aggressively. We are going for a faster taper. They've completed their tapering faster than America. They tapered shorter than America. ECB, despite the fact that the war is there, they are pushing for interest rate hikes ASAP, quicker, despite the war. So the markets are like, what on earth is going on? I mean, if the markets could talk, I think that's what they would say. But all in all, I think I've given you guys kind of like where my mind is, right? Took me a while to kind of like figure that out for myself. Right now, here we go. So Euro markets are a bit strong. Euro markets open lukewarm ahead of the Fed's decision, right? Look at it this way. If the Fed does give us a strong interest rate hike and the dollar likes it, and Euro markets are strong, Euro USD is strong, Euro blah, blah, blah is strong, Pound USD is strong, you can expect a sell-off later on if the dollar will rally, right? But we're going to look at those price levels. We are not going to do drunk things today. We're going to look at price levels. I don't know how long I will be. If you're in a rush, I understand. But I'm also doing this for my trading desk too. So I'm just recording myself talking to you, which would normally be me talking to myself or to my team. Right. So here we go. So FTSE, your markets are a bit positive, right? Hong Kong, right? Rising about 9%, right? We're talking about Chinese stock markets about a day or two ago, and I woke up today, I saw there was an 8% jump in the Chinese stock market out of nowhere. I don't know why. I haven't looked into it. If it's okay with you, I'm gonna move on. Guys, be careful about this kind of stuff. Let me show you. Let me show you. Let me show you. Can you read this headline? Hong Kong Hang Seng extends surge, rising about 9% as Tencent Alibaba jump more than 20%. That's the headline. That's a bullish headline. Bullish. I didn't say the other way. I said bullish. It's a bullish headline. It's a good bull run headline. Why I call crap on the stuff all the time is because all you have to do is come to your charts. Because this is where retail traders get stuck all the time. It's not just retail traders, although I don't expect this from professional traders, but some of them make this mistake on a day-to-day. There's a chart. This is Alibaba. They just told you that Alibaba has jumped 20%, and you have to always, like crypto. Last week when Janet, whatever that old gogo, put out that the crypto regulations are transformative and encourage innovation. The headlines: Bitcoin jumps 10%. It's bull. So everyone went to Bitcoin and bought. You saw those at 10% rally. I sold. I sold because if I want to sell something, I always need buyers anyway. When you tell me that this asset, Alibaba or Chinese market, has gone up 10%, I have no choice but to ask myself, 10% from where? It has to be relative. You have to use the medulla oblongata. From where? Because if it's 10% from the all-time high and it's an additional 10% from an all-time high, that's bullish for me. But if the stock has fallen a good classic 76%, and today the headline is it's gone up by 10%, then all it means to me is you are still down 20%, so that's 25% actually. You are still down 50%. It is not good news. It is okay news. It is that positive stuff that we can talk about. It is a positive day for stocks that have been thoroughly beaten. This in no way facilitates a buying opportunity for me. I would be crazy to think that this is what it means. If I read my chart structure correctly, all I can see is markets need to jump up another 10% so that someone who is smart enough can start selling against anyone buying these news headlines. So be careful of that kind of stuff. This means nothing to you and I until we have market reversals. How do you look for those? You look at your structures, you look at higher highs, you look at supplies being taken out by strong demand. Until you have that repositioning of money, Chinese stock market is still falling in my head, right? I'm never going to waste my time with this stuff because the headlines here generally don't help. We like coming here just to get a temperature check. Oil is back, right? I mean, I won't lie, but I told you guys that one day oil is going to come back to these levels. I marked these levels for you. I don't know who took them seriously, but oil is back. Oil is back where where we wanted it to come. Now, question is, can oil handle it? Remember, we put some buy orders here. They're gonna be like, no, we didn't, Leroy. No, you didn't tell us. I told you. When oil tore up $100 I say, ain't nowhere else I want to buy in my life than down here first, because I looked at the structure. Markets have come back here, all right, and now I'm simply waiting for a couple of things. I might take a loss because it's a sentiment-driven market, but what I want to see is on the H4 time frame, I need this taken out. And then I kind of need this taken out. Until those two levels are taken out, I can't break even. I'm stuck, because if you look on the daily, this is a big area of value to be scared of. All right, not scared of, sorry, a big area of value to expect some reaction to. Right, so I've got to buy here. Markets have sold against any single damn person who was buying the high, because oil was up at 115, 15, 106. You started buying. That's crazy. You always go wait at a demand outside of a supply. I've taught this too many times to repeat myself. So I gave you this, guys, this area of value. Those of you who are in with me, I'm giving you my game plan. It's a very unsure moment. We are happy that they took out this supply, but this supply means nothing to us. It was damn money there. Money, anyone who's selling at the entry point of a valid demand is a retail trader. That's not smart money. So yes, this supply is going to be taken out. What we want to take out are institutional supplies. What we want to see the banks take these areas seriously. The first one is here. So I'm risk active in this trade up until I see a supply, a valid banker supply being taken out, right? So I'll update you on how this trade goes. I'm hoping for the best. I'm happy if my stop loss gets taken out. If it does, it's really, really sentiment, right? If things go okay in the war, if peace talks with Ukraine aren't easy, but there is certain hope for compromise, oil will keep going down. If Russia and the sanctions, wherever they are, it will affect oil. But I'm in the trade nonetheless, so we'll see how that goes. But we spoke about, I gave you guys that signal a while ago. Right, so oil there, Brent is still above $100. Brent being nice and stubborn. Gas is still a bit up. That's fine. Gold yesterday was at 933. Gold is dropping. Gold is dropping just before an FOMC meeting, making way for a potential run as a safe haven asset, or getting out the way for the dollar to rally. But someone is taking profit on gold right now, right? Affecting all these other markets. If you guys hear another sound, that's just me. Please ignore me. Crypto, Bitcoin back to the 40,000 bucks. Right, good range. There's a lot to talk about XRP. I don't know if you guys know this, but we did good with the case. We'll talk about that stuff, in another video. And then your futures markets are down but up. Down because we're still down here to 13,000, blah, blah, blah. But green, better than yesterday, right? Slightly better than yesterday. But you see, smart money is frozen. Futures are flat ahead of FOMC tonight, right? So the kind of like markets are waiting, right? So the trade setups that I'm about to go through with you guys, for those of you who are still very patient and kind human beings, still listening to my annoying voice, are going to be trade setups that I am going to wait for. Are trade setups that are going to happen despite of tonight, because that's how I trade. I don't trade the news, I trade smart money. And I want to start off with gold, because we have to make an adjustment to what's going on in gold, right? So gold has finally arrived at an area of value that I said could hold. I said this area is one of the first main potential areas. I posted this on social media. I don't know if I put on my Telegram, but it's there on my Instagram, my personal Instagram, and the 365 page, right? Because I write these notes for social media posts. Right now, could hold, but this is no good for a swing trade. That's what I wrote back there. Now, the only reason why I'm triggered and holding a tiny lot size, about 0.10, and it's just one. I'm not really taking this trade as seriously as I should. It's fundamentally because price is now here, and price is going to stay somewhere here in this range for the next 10 hours until FOMC says what he wants to say. All right. The reason why I was able to tell 2 to 3 weeks before this that this area is not a good place for a long-term swing trade is because markets like using these specific areas to manipulate and bounce off during news events. And I believe this to be true because markets had arrived at a very big monthly supply. You'll remember markets here in gold basically tried their level best to challenge the all-time high. I don't know if you guys last week saw the headlines. I don't know if they were headlines when I was away, but markets came so close to challenging the 2020 COVID all-time high. When gold comes to all-time highs, it means things in the world are bad. When gold came here in 2020, and remember, we all understand COVID. We understand how bad COVID was. We understand how little we knew about it. We understand how many people were dying, etc. This was the safe haven flow. But we also know that when gold gets to what we teach in our module 1, major turning point, right? Which is this. Because if you look left, this was the highest gold had ever been in its history. So it became a major turning point. Markets have to come down because in that process, they have to honor a supply. Now, this year it's different because there is already a supply that has been violated multiple times. There's already a new all-time high that markets are challenging. And this is the month of March. This candlestick here is the month of March. We still have about 15 days before the month of March ends. This candlestick now has a wick inside the area of value H4 place where I said, price could hold, but it's not good for a swing. And a wick means a couple of things. For a green candle, those of you who don't know, a green candle, let's explain this green. A green candle opens at the bottom because you want to buy low, it's a green candle, but a green candle closes at the top of the body because that's where you want to close. You want to buy low and take profit high. There is a lot of room for a body to grow in the month of March before this candle closes on the last day. Just be aware of this. Yeah, I see that money was looking for short-term traders. Those people were buying the highs, trying to buy gold at 1933, 1934. They've all been taken out. This is why we look at the charts well ahead of time and we predict exactly where price is going to be, and we go wait in those areas because at 365, we know markets are not random. Human beings are random, and that's their problem. Markets are not random. Now, here, sure, I've got a good buy trade for maybe an intraday position. It could even turn into a swing. I don't know. But I know for a fact that I'm not taking this buy seriously. If I am ever blessed and lucky for markets to come even lower for swing buys, these buy orders down here, I guarantee you are the buy orders that will take us to new all-time highs down here. I don't think this one will, but I do think if price is allowed to retest with the intraday buys that I've set up and come back down for a couple of another month, another week or two, or whatever, the buying that will happen into the month of April might lead us to all-time highs. Granted, gold is a slow mover. You ever seen those people on social media who are so annoying, who go, gold is back. If gold moves, things, when things are bad, run to gold. gold will give you blah, 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 blah. Gold moves very slowly. It's a safe haven class, and there are many other safe haven classes to look at. And gold loves to consolidate and trade in ranges. And we all know that we really want strong volatility and strong trends, right? There's nothing wrong with trading gold. I'm just saying, people who say that stuff always make it look like gold will give you more return on value than crypto, and that's a lie. It's an ignorant lie. Crypto always pay you more because of its volatile nature. It'll take more away from you and it will pay you more, right? It's just how life is. Now when it comes to gold, like I say, there's nothing I can do about this trade. It's already triggered and it's very low cost for me. It's a very small lot size. If my stop loss to get hit, it really wouldn't matter, right? I don't yet have faith that this is the best level for gold anyways, for markets to kind of like start to swing a long-term buys, right? But somewhere down here, I'd be very much interested. Why? We've got a weekly demand, we've got daily demands, we've got H4 demands. It's a very beautiful hallmark area, right? So this is what it looks like on the daily chart, but you can see you've got some arrow effect where prices come in a little bit hard on that level, and somewhere above there is a bearish engulfing pattern, a failed supply, a failed break of the all-time high supply. So these are kind of like things that I'm looking into. So for me, my heavy buys in gold are entirely inside this class. I think I've got 3 trades, one here with a very smaller, a lot size compared to the other 2. So I've got I think it's about a 0.25 here. This is all based on your capital. Do not take my lot sizes when your capital is not like mine. Do not take my lot sizes if you don't have the ability to take risk reward ratios of 1:3 in a swing, because it won't be worth it. You will blow your account, right? So, and that's fine, because my stop loss for the first trade idea is that wide. That's why I use a small lot size. Then after that, I use 0.50 on the smaller areas of value with a tighter stop, right? So I'm waiting for gold there. Right, what the FOMC will say or do today will heavily impact how gold is going to move. I can guarantee that. The next one is our classic Euro USD. Right, you saw for yourself, the Euro is a little bit strong today, right? On the back of FOMC stuff, you know that my deepest heart's desire was to get one more sell up here. You know that this was never going to work for me. This was never going to be good enough. I could not have considered that a good place to buy. I can tell you that if inside my own trading flow, right, we've got people who sold right there, and the reason is it's a valid supply, right? Remember, I have rules that have helped me along the years, rules that for the life of me are so petty, so strict, but I like them because they ensure my capital, sees the day, right? So if you were to convert supply and demand and couple with a lot of BMS and market execution, what would have happened is, or at least what this trader did, was he watched how price came in. He did see that this area is gonna be exhausted. Almost sell orders will have to have been taken solely for the sole purposes of just completely knocking out price and dropping price a whole lot lower, which is exactly what happened here. Moving forward from that, all most of these guys do is they wait to see a new type of entry, right? They see a long wick here, doji wick there, and he started to sell somewhere down here, hoping to sell price down, and that went his way. I can't take trades like that, man. I'm not into those kind of like high risk stuff. This is the only safe trade to have taken on this chart, by the way, was to simply wait for all of that to be done. So they've taken out the supply. Let's say you tried to sell here, and I didn't tell you to, but let's say you did because you're doing your own thing and your stop loss got hit, and then you came back to figure out why. If you take a trade and you lose, if you take a trade and you lose, if it's a swing trade on the daily time frame, make sure on your journal you write that trade down, that you lost it. And after 4 to 5 days, or just make it routinely like me, every Friday, if I lose, and I remember I said if I lose a trade that week on Fridays, there'll be a video about it. I haven't had a video out because there's really not much swings that have been taken anyways. The intraday trades that have been taken have been going very well. But on Fridays, or every 4 to 5 days of your swings, come back to the chart. Come see why you lost. You won't know why you lost the trade on the day you lost the trade. You will say, I lost the trade because of my stop loss got hit. That is not why you lost the trade. Your stop loss got hit because you're part of liquidity. That's not why you lost. You need to come get the logic of why. So after 3 to 4, 5 days, oh, okay, my stop loss got hit here. Day 1, day 2, day 3, day 4. Wait a minute. Markets come back. Markets created a new supply here. Markets came back there. Boom. You could have taken that trade. You just have to be paying attention. If you don't have a routine, guys, if you don't have like a mechanical way, I don't know whether you guys just trade on or look at charts once a week for an hour. I don't know what your system is. I don't know what your life is like with kids and work and no kids and whatever. But you have to have a routine, right? Because this was a clean entry. I could have taken this. I just didn't want to. I didn't want to because I didn't want to be tied capital down to a swing. At that time, I was busy, blah, blah, blah. But this is a good place to wait for. But now, where's markets right now are 10 hours before FOMC, all the way down there. Do I think markets are going to come all the way up here today? Absolutely not. It's impossible. The only way for markets to shoot so high up, which is impossible, it's not going to happen. But the only way for markets to shoot that high up, which is not going to happen, is if FOMC pulls a rug and says, yeah, guys, I'm dovish because of the war. 0% interest rate hike because of the war. And then the dollar will come crashing down like you have no idea. It'll feel like, the first time your mother told you she's not your mother, right? That's how the markets are going to react. The dollar will crashing down, and the corresponding response for the euro will be to go up. That's it. I don't even think markets will make it up there. This is what you need to know historically about interest rate hikes. Those of you who've been following me for a very long time, you will know that in all my charts last year, I marked 16 June, FOMC. And last year, I was clear that interest rate hike was going to go up. So last year, I sold like a crazy human being inside this order block. You see it's still there on the chart. I keep the same chart. I mark over them over time. I bought like crazy my DXY and I sold like crazy in my Euro USD. Bearing in mind we were already in some sells here because of structure, because markets had arrived at a governing supply and markets were obviously going to fall. But on the 16th of June, when the FOMC increased the interest rate by 0.25, look at how euro reacted. Bearish engulfing candle. Markets, you wouldn't have, if you snooze, you lose. Markets are volatile. They move fast, right? So only the stuff that I've been trying to do with you guys in the mornings and that intraday time frames, especially what I taught you guys last night. The only way you're going to catch these type of trades is you take these type of trades an hour after, or just a few, 2 or 3 hours after the meeting, when markets are coming back to retest levels, because after that, price is gone. Markets on the daily time frame never returned back to the supply. They never did. But on the smaller time frames, you get a couple of good entries. And if you can hold your gut, really hold your stance, you could be a part of a very good, beautiful movement, right? So remember, the whole theme of today's War Room is around the interest rate hike. And I want you to understand it. Oh, this is taking forever. All right. So I'm just scrolling, trying to get to some candlesticks. And I don't even know if markets are even following what I'm doing. Right. I just have to wait. Because I moved from like daily to 15 minutes and I've gone back almost a year. Man, I don't know what to do while we wait. But you have to see the stuff. But anyways, there'll be 15-minute supplies somewhere nested in there. And I don't want to just talk about these areas without showing them to you. I really wanted you to see them, but I can't even see how far the candlesticks are. Markets are still printing historical candlesticks. I'm sorry, guys, but this is just awkward, right? I'm just sitting here waiting. Right, let's go 1 hour. Maybe 15 minutes is so tight. Let's go 1 hour. Right? There we go. Right? So 1 hour is a little bit better. Let's see if you might be lucky on the 1 hour time frame. Nah, bro. You are not. Right. So one of the reasons why I got into this trade was because I found my supplies so much earlier and I took them. I took them ahead of the meeting. Took them big lots ahead of the meeting because it was clear. I've shown you guys the Fed monitoring tool. All these things are in front of you. You can predict what's going to happen. So I did the same routine last year. I knew what was going to happen. And as soon as market struck, you see, this is 15 the day before I sold here. But see my arrow to remind me, sold here the day before. The interest rate hikes dropped here at 8 o'clock. somewhere here, and markets exploded. But I'm saying I started selling here, and then the whole day during the day, I allowed euro to do whatever it was going to do. I was going to be part of the drop. Look at these order blocks. Nothing was tested. This imbalance is big. Nothing has been recorrected. Now let's see if we can see if during or after the news you'd have been able to be been lucky. And this is about 9 p.m. on the day. So is it 9 p.m.? Yeah. So FOMC is tonight at 8 o'clock. So this happened at 9. I can't see any activity there. I'm going to drop 15 minutes now and see if we'll get a clearer picture where I marked a circle. If I don't, I'll move on, guys, because of time. I'll move on, but this is just to help you who might be thinking of taking a trade sometime today. We can't even get to the red thing. All right, there we go. But if the candlesticks take forever on the 15 minutes, unfortunately, you'll forgive me. I'm gonna have to move on. Right, so it's stuck here again. It's not gonna allow me. Right, so most likely because of how volatile it was, you would not have been able to catch the move there on the 1 hour. But this thing fell the whole year because of that meeting. All of June up until this year, February. So there were many other entries that you could have taken, many other entries. Right, there is the first time, the very next day, opening of the Asian markets. Markets start a big order block up here. Markets don't even get to return to that order block. All the ones down come back in, close out, not even able to take it. I mean, you could have taken this, but you've been stopped out. Taken this, stopped out. Right. This is where it gets interesting. This is where we start to trade off these levels. Once you see a bearish engulfing pattern, all you're waiting for is a retracement into these levels on the 1 hour time frame. And you could have held it. And you could have held it. And price, unfortunately or fortunately, depending on how you see it, price never comes back. Never comes back to take you out. Never comes back after that. You're done. And so, just so we're clear, you don't have to try to catch this movement. On the 16th of June, it took at least another 2 to 3 days for everybody else to find entries into the trade. Here I'm on the 25th of June. After that, markets really ran with the trend and never came back to any of those areas to take in on out, right? This was a continued motion of downward pressure. Look at how far this is. Never back into that yellow zone where we spoke about. This you could have taken if you wanted, right? We spoke about this last year in a war room. We took that one trade that I know. But for the most part, it's just a beautiful flow of supply and demand. Now, to today, markets are going to do something similar. But remember, 0.25 basis point is to be expected. It is an expected area. It is expected type of thing. So the dollar might not rally as strongly as you want it to go. Euro right now is challenging supplies and technically speaking, in my humble opinion, breaking them, right? So will this be the full stop for Euro USD? I don't know. I'm not convinced, right? There's still a lot of time. Prices already here. We still have the New York session that starts at 3 o'clock. We still have quite a bit. It'll be interesting to see how far price goes. I mean, Euro right now is just set, right? So what could happen is if markets truly believe that the dollar is going to be strong, this was broken, I'm pretty sure, was it not? No, it wasn't, right? So there's a big supply here, which is currently controlling price, right? So price from this big supply went up and is now slowly starting to come back. Now, if Euro believes or the markets believe that, look, man, the Fed's going to pull a rug over everyone, the dollar is going to fall, then you could see Euro eating through this area, but it's going to struggle. It's not an easy thing to break a supply. And even if it is to break the supply, this is where the problem is. So for short-term traders, for short-term risk traders, it's not really a cowboy type of trade, but maybe a pony boy type of trade, right? So it's not that high risk, but you can still fall off the horse, right? If dollar was to be strong because of today, I wouldn't want to sell anywhere else in the world on Euro USD except if that area of value was fresh. I would not want to touch any other area of value in Euro USD unless that area of value is fresh. Now, when I look at this movement and I look at the time and I say this thing is in about 10 hours, I wonder if markets have enough volatility and effort to move in one day another 195 pips. I know that's impossible. Historically, that's impossible, which means for me, in this particular interest rate hike, I will not be able to trade the Euro US dollar. What you could do, however, is look for a potential play here. All right, so markets moving between now and 8 p.m. another 55 pips is a strong reality. I don't see markets doing 195 pips in a day. It's just not how Euro USD moves. Doesn't matter what's going on, right? So Euro USD, watch out for this. I don't think you should rush to sell right now. I don't think you should rush to buy. I think you should rush for the data. The data will tell you what to do, right? Euro USD, just so you forgot, if you've already forgotten, is at the area we called B, which is blocking the way to C, which is a demand in the way of a lower demand, right? And Euro USD has done a very good job of reacting to that demand, reacting correctly, right? But has also done an interesting job of digging very deep into it, right? Really deep into it. And so we would like to see this chart somewhere here by the second financial quarter, which means in the bigger scheme of things, euro is still due to drop, dollar is still due to rise. And so what happens today might not even bother to affect that, right? So that's Euro USD. I hope that helped you guys. AUD USD. I'm going to go straight to the daily. We've got a breakout here. We've got something that looks very much like pound USD on the governing time frame. I don't know if you guys remember me talking about this. Pound USD has got a demand here, but Euro USD is already all the way down there. Pound USD has to first deal with this break, this demand, and break it before price can even bother to consider going all the way down there. All right, and what AUD USD has done is created a bearish engulfing pattern, a PCP around it, breaking this demand. I think this demand is broken. Let's find out. There it is. There's that wick there, broken, and found lower, smaller time frame demands and bounced from them with those orders, which is perfectly fine. And now this is where price is. Now, for the most part, with the governing demand taken out on the left, right, markets, and they're taken out very, 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 very slightly, right, with a double, what's it called, the double bottom, those patterns, double bottom here on price is interesting, right? Markets have gone back to this trend line area here, and markets have reacted appropriately to the trend line, dropping immediately. Any type of idea that price is going to go above the trend line, right? Markets completely dropped that assumption. Trend line hit into a supply. The supply is not any type of supply. You can see here there's weekly supplies. This is a bearish engulfing pattern. Sorry about the extra notations inside there, but there we go, clear as day. Bearish engulfing pattern. Markets try and make their way. Next to it is a supportive downward holding trend line, this white line here. So markets really into that, into potentially a perceived area of value here, into a potential neckline, and markets drop non-stop for another 2 weeks, which means if weekly is showing us anything, it means that Euro USD's path right now is towards the downside. Sorry, AUD USD, right? And we can start to talk about price targets all the way down there, but we'll get to that if we like, right? On the daily time frame, this is what it looks like. So on the daily time frame, we've got this area of value, which used to be a demand. You can see there used to be a demand. Markets came back, reacted to this area of value, then created a supply. And then now that supply is what broke structure, breaking the demand and going to the downside, but didn't close any lower than the previous candlesticks. So I'll do something like this instead. Why? Because I feel like that is a far much more use of time and supply. This is a very good supply area, and it's got good timing, right? I mean, it'll take a little bit of time, but it's good timing. It's like a 2 to 3 days type of situation. Markets are here right now on the daily time frame. Then you're about 2 to 3 candles away from testing this area and actually seeing where price leads, right? If price falls, then that's perfect. Like that, right? So that's the daily chart on the H4 time frame. We've got markets making their way, covering gaps, markets reacting positive to a demand, markets coming back to sit where this demand is, and the gap, the impulse gap, and then markets already going back up. Just want to remind myself, so you guys remember the stuff when I teach in module 2, in module 1, actually, I started doing this a lot. DS1, I found that it helped a lot of people when you actually know which supply you're dealing with. One being obviously the most immediate supply that you're going to have to face versus a distant supply. Because when you start to do your multiple time frame analysis, things become a little bit tricky, right? AUD USD is a US dollar pair. Imagine if this interest rate hikes happen and the dollar is strong. What's going to happen to AUD? It's too strong. AUD is going to fall. And so I want to make sure I am prepared for a fall in AUD USD. Well, if I'm looking for a fall in AUD USD, I probably should sell here on the H4 time frame. Why is that a good place to sell on the H4 time frame? Well, there are a couple of reasons. Number one, that H4 supply is nested in a daily supply. We've just proved that, right? We first had to go right our D1, DS1. But number two, it's broken structure, which shows strong commitment to price. Number three, if I have an entry point right here, I could have a high or lot size there, or I could have a lot, smaller lot size with my stop loss up there, right? It's a dealer's choice, but it's definitely a choice to be made here on both fronts. So please look out for that. Again, you have to just wait for the data, just find out what the markets are doing. A strong dollar would have to push AUD down, right? But right now, as a normal swing trader, I definitely want to get a piece of that pie, AUD USD. I want to work it out. AUDUSD has been breaking rank of late, doing its own thing. Right, on the 2-hour time frame, I'll still take that area there. This is what most retail traders are going to be doing today. They're going to try and sell here at a point of a flip zone between support and resistance. I'm not interested in any of that kind of stuff. I'm going to wait for a better supply, a rally-based drop type of situation. So AUD USD, that's my cup of tea over there. All right, good luck there. Done Euro USD, I've done AUD USD. I'm going to move on to Pound USD. Pound USD, I'll be surprised if markets don't make it back to that NFP zone. All right, let's find it. Yeah, beautiful, right? Right, so I've already marked the zone here. Same play, break of structure, supply zone, da 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 da. I'm waiting for markets to come there. I mean, that's just me. I have nothing. I have nothing to rush for, right? Do I think markets are going to come here because of FOMC tonight? I don't think so. It's too far. It's too far a move, right? I do think that, if you're looking for a much more immediate trade, that this is a better place to wait. But I think you should wait here with a massive pinch of salt. You should wait here with making sure that you've already paid for your DSTV, you've paid for your Wi-Fi, you're good to go. You paid for your life policies, because this trade might not work out. This is not really, it's a low supply, it's a sell low. Yes. Given the two options, this is a perfect sell high. If of course you're saying, but there's also supply there, so that won't work. And if that's the case, then yeah, this is literally looking like the only zone to take a trade, an immediate trade from. And I want to be very clear about that immediate trade. But otherwise, I'm going to wait here. I might take a short-term trade there, or take a short-term low, small lot size risk trade here, like a 0.10 or something. But for the most part, I don't think this is the most interesting place for markets to be right now, right? But markets could do that, right? So that's Pound USD. For the most part, just so we're clear, I'm going to wait for my area of value up there and then take it from there. So that's Pound USD done. USD CAD, guys, USD CAD. If you find DXY easy to read, and I think it is, I find DXY extremely easy to read. Because it's not it's an index, right? Number one, it's not like two currencies, like US dollar versus Canadian dollar. There's two currencies involved, two different, geopolitical factors. Dollar is just a dollar. I find that if you find the dollar easy to read and you can follow what the dollar is doing, you can easily adopt to what is needed here in USD CAD, because the USD CAD chart and the DXY chart, I always find their parallels, or their what's it called? Their correlations. There we go. Their correlations are profound. Now let's just quickly go to the 1-hour time frame to remind you of the opportunities we spotted here in USD CAD a while back, right? So we spoke about these levels quite a bit. Want to go to the 50 minutes time frame. There we go. Right. So this we spoke about, in our previous forums on the DXY, and I say DXY because here, guys, on the 4th of March, we were mapping the gaps in the dollar. All right, there were dollar gaps here, and we thought that, okay, look, man, USDCAD was going to come back to those same levels, and it did. US dollar did come back to the exact same level. There you go. You can't make this up, and you can't ever catch me slipping. You can't ever convince me to try a new trading strategy. You can't ever convince me to try a system, a trading bot, this and that. So this is all I need. I need to see price. I need to see price hit a demand. I need to see price hit a supply, and I'm good, right? So USDCAD, did this kind of stuff, and for the most part, you really just want to trade this thing pound for pound, time for time with the dollar. So I'm just going to pull up the DXY chart there and then see where, if we can correctly read whether the dollar is going to go up or down, there's a high chance that USDCAD is going to follow suit. It won't follow suit almost with immediate effect, but it definitely does a good job of faring. It does a good job of kind of like working through, the optics, what's going on here. All right, so I've got the dollar this side. So let's put USDCAD there. This side I've got we've got pound. Look at Bitcoin. Bitcoin is now trying to fill some market inefficiencies and all that good stuff. Right. So what's interesting and what I really like about the dollar is in a clean uptrend, right? You can see for yourself, clean uptrend. You can see there's nothing stopping. It's literally from the bottom coming up and up and up. And whereas USDCAD, you can see that markets were actually, at some point at a similar level. Then price actually at some point came down, and then markets went back up, right? So this is H4, this is H4, right? Dollar index H4, USDCAD also H4, all right? So everyone, we're looking at the same timelines. I'm going to delete that now, right? So now markets have done some type of range here in the DXY, and then markets are now, finally ready to leave to the downside. Let's say by happen chance, since this week here was here to simply cover the gap, right? So let's say that didn't happen, right? So let's say markets don't stop anywhere else and markets come all the way down there. Well, then the same has to be true for USDCAD. Generally speaking, like I said, there is a lot of correlation, a lot of market correlation between USDCAD and the dollar. Just trying to clean this chart up, but it won't allow me to. Come on. Right, perfect. Right. So if I look at this thing here on the H4 time frame, and by thing I'm talking about the DXY chart on my left. This is DXY, this is USDCAD, and I do the exact same thing on USDCAD where I'm looking for the next area of value. I will acknowledge a couple of things. Number one, there you go. Number one, markets in USDCAD seemingly want to go a little bit lower and trigger a demand. That's number one. Number two, markets have already done this. So markets have already come into this demand here and then gone back up into the supply, and then the markets are coming back, right? So the question is, will this area hold? Do we want it to hold? Does smart money want it to hold? It's different. But if you look to your left, the dollar doesn't even have a level like that. Yes, on the normal candlesticks, it's there. It's there. There's a level there right now where price could fall into. On the normal candlesticks, I agree with you, it is there. But it is something that you need to be aware of, right? That this area might not hold because markets here seemingly are saying, look, man, we have used this area of exhausted it, now we're back again. Like price is coming back again like this and opening up these supplies. This zone is in trouble. It's going to break, which means for me, USD might want to go a little bit lower. And if that's the case, it also means for me that I must be very careful because the dollar might not be able to sustain an upward movement today. But if that's the case, then what's the FOMC going to say? Is he going to do a rug pull? Is markets going to get what has already been priced in? 0.25% has already been priced in. Therefore, not much volatility, not much movement. Why is Bitcoin running so fast? Is Bitcoin running for a buy setup or a sell setup? right? What's that about, right? These are kind of like all the questions in my head. But right now in USD CAD, we've got a situation that looks like this. Markets have already arrived at a demand that is slightly weak. That won't change the outcome. If markets do buy from that level, when price ever comes back to that demand has to break, right? So markets are not interested. So to me, it looks like, looking at my DXY Kinahashi candlesticks and waiting for a further drop here feels and seems prudent. There, right? So that's what I'll be looking out for. I mean, you could get something like this, of course, in USD CAD, interest supply, then markets push price down. But that's really what I'm looking out for. I hope that that is very clear to you. Right, USD CAD done. I'm just trying to quickly find another USD chart. Did pound USD, AUD USD, we did gold, we did AUD USD, pound USD. Okay, we can look at USD Swiss franc, USDJPY, and then I'm going to call it a day, ladies and gentlemen. Just two more charts, USD Swiss franc. You guys can like get the gist, man. I mean, I personally would far much more rather enjoy the conference, watch it, stream it with you, make commentary, make sense of the world than trade news. Buy, sell, because everything that FOMC is going to say, markets are going to go up and down, up and down, up and down, up and down. It's going to be crazy. I'm going to see if I can set it up for you there. Right, daily supply on USD Swiss franc worked very well. Another sell here worked very well, and then markets went up. Right, now what's going on here? Let's have a look at the bigger picture. Yeah, okay, so this was always on its way up. Governing demand is in charge. There is no governing supply to the left. There is no governing supply to the left, but what we do have on Euro Swiss franc, so pretty. Time for swing trades. Swing traders, hello. Look at this. We've got a new order block here on the governing time frame. So somewhere inside here, ladies and gentlemen, we want to see retracement, and we want to see price come back down there for us. Like for a long term, that's the weekly time frame right there, where we last sold into this big red candle. A strong bullish engulfing area has been made on the daily time frame. That's happening, right? So this is what we want to see. This big yellow area is the one that I just drew right now, right? So I will be looking in the long term to buy somewhere down here. In the long term, right? I'm gonna see what happens. It'll be so nice if FOMC says good stuff about the markets or scary stuff, whatever the dollar needs today. Whatever the dollar wants, the freak of the day. I would love to see this daily supply taken out first. I'd love that. If it doesn't, it won't stop me, but that would be great. Price takes the daily supply out first, then price comes back for me down here. Markets have every single right in the world to stop here. Right, so maybe you want to look out for something like that. Unfortunately, I do not recommend that a single trader in the world covers both areas of value with one stop loss. That's a lot of risk you're taking, even if you're using such a small lot size. It's just not good enough. Like it's 119, right? So you could want to risk, one trade there and two good trades here, something like that, and then see where we go. But it looks like we've got a long way to go to the moon. So there's nothing much there. USDJPY, my last shot for the day. I did a very honest, reflective post on Instagram around this beautiful pair. This was a dead giveaway. It was obvious that markets were going to break out of this to the upside, but I didn't take the trade because fundamentally I would love price to come down here, and this is a perfect buy. And I was just explaining to you guys in that Instagram post that, look, man, this is just how I am. I don't think I missed out on money because I didn't buy into it already. It just doesn't make sense for me to buy here when I know there's a big supply there. It worked here. It worked here. It worked very well here. But you don't know, when these things work. The overall target for USD JPY, I don't know if I've told you, I have. I know I have. You just check the war rooms, but I have, is 12221, right? And this is a big target for USD JPY. We're going through monetary divergency policy. I think we might get there by October, before October. So it'll be very nice if markets at some point snap from this parabolic structure. Whoever was asking about parabolic structure, there it is there. Market snap here and then come back down. It might never be all the way down there, right? I might have to leave my pending orders here nonetheless, and then start to find a new buy order somewhere there. All right, so I'd happily take a new buy trade here, somewhere down there, if markets were to snap. Now, if I look to the left, because I'm assuming these supplies that I have drawn here are either daily, weekly supplies or something, it really is interesting to see what's hiding here. You could think you're waiting for supplies and only have his pivot highs, right? So that's broken. That's a rally. That's not. That's still fresh. Yeah. I'm gonna wait to see. So USDJPY for me is a wait and see. Oh wait, this where price is now. So markets are almost done taking all of this out. When markets take all of this out, we really need to consider, right? So this could be at play though. I don't like what I'm seeing on the left. That's why I'm a bit hesitant. I don't want to rush to qualify it as a strong supply. You know, will it really cause a turning point? Where's my base? You know, okay, I got a really base drop, right? So this might be an interesting place. Markets might break the current supply they're in right now, right? Because of this, but this reacting to that and that reacting to the above and etc. Right, so we'll see. So this is where markets are, this green dotted line. This is where markets need to be. Markets still need to go all the way there. So I would really hope that after price breaks the supply, before making contact with this line, or maybe it will need to make contact with the line, right? Based on the FOMC speech, we will know in the next 2 days how FOMC affected this area of value, right? Because if markets come in here, it might be a good time to sell, depending on what the rate saga is tonight. And if it is, I'm happy to sell all the way down there and then buy back into the target, right? But we're very close to this target. Bank of Japan is actually now starting to consider, its perspective on stimulus as well, right? So look out for that on USDJPY. Nasdaq, right? Because they'll inbox me. And I'm so bad with that kind of stuff, but they will still inbox me and ask me. So let's talk to them about Nasdaq, guys. You wouldn't believe why I was doing a video for you guys and I removed almost 2 years worth of 365 numbers and analysis on the Nasdaq chart. So all these lines are inaccurately drawn. This is as good as a naked chart right now, and I still need to work on that. Right, so Nasdaq is kind of like pumping up today. We can see that it's an adventurous pump. We can also see that it kind of like left a demand. But we've seen that before. We've seen price leave a demand there just for price to rotate around it. Seen price leave a demand there just for price to rotate around it. We might get the similar thing, for the next coming few days into next week, but it will depend. But the fact that markets are pre-moving sometimes always suggests something, right? So just be very mindful of it. This is the H4 time frame, and we're here right now in the H4 time frame, and we just started the London session, so we are nowhere close to the New York session. And it doesn't look like markets are going to slow down. Doesn't look like that at all. And so because of that, no. Yeah. So because of that, be very careful. I think markets are going to do a swift turn just before FOMC. Just before FOMC meeting, sometime this afternoon. FOMC meeting, remember, is at 8 p.m. Nasdaq will have had a long time to run, right? So let's look at this level correctly. The one that I've just drawn, you've got a Talitha area, you've got an imbalance, and you've got a bearish engulfing reaction to it. You've got a bearish engulfing reaction to it. What do you think is going to happen here? Right? A retail trader, your mind is preset automatically to assume markets are going to drop again, right? Just be wary of that stuff. It could happen. I'm not saying it won't happen because this order block is quite intact. If I was a Nasdaq seller, I'm not selling until I get here. I'm only selling when I get here because by then I'll know where we stand in the future of markets. Again, we're not expecting surprises, but if they do a rug pull, which they can, which they will, right? If they do a rug pull, because this doesn't make sense, by the way, I didn't touch on this. 0.25 for this month makes sense because we voted on it. But FOMC said, look, man, we need to do the 2004 mod, which is 0.25 every month for a long time. But next month, smart money and markets are pricing in 0.50. They are pricing a much more aggressive stance, right? And just to add all of this and maybe add it to the end, I think I've told you guys what I think about Nasdaq, right? I'm gonna wait to sell up there. I'm not yet even in the mood to buy Nasdaq. I haven't been in the mood to buy Nasdaq for a very long time. I'm not gonna change my mind about that. But I want to conclude today's war room with the last thing. If you watch the press, if you don't watch them, then it doesn't matter. It honestly would not make a difference. But if you watch it, if you watch this thing, and the questions, these are the questions that are always asked by the Fed, you will notice that sometimes there's an interesting thing, and we like to call it the license. It takes forever to type the word license to hike. The Fed has the license to hike. And what this is, guys, is a sentiment check. I don't know how best to teach this stuff. And you have to see it happen so many times. It's a sentiment check. He's gonna also, he knows what he's gonna say today, but he's going to also want to test the markets. So he's gonna say stuff like this. Look, I'm gonna go 0.25 today. And then the markets are gonna be like, yay. Yay. And you're going to watch your charts, you're going to see some movement that they're happy that what the Fed is going to, what the Fed has said. You'll see this. Go to 5 minutes, 15 minutes on your phone, and while the Fed is talking, just look at where the volatility is and try and see if you can remember what he said to move markets quickly, in that second, right? So someone's just going to dump a whole lot of money at that. Feel like, yay, that we expected this. Thank you so much. Well done, sir. Then I guarantee, remember, they say there are two things to watch out for that I think he's going to say. First of all, he's going to talk about a once-off price shock when he's referring to war, oil, commodities, food, meaning it's going to go away. Watch out for that. But the other thing that he's going to say after he brings up this interest rate hike is, I'm pretty sure during the questions or during the statement, he's also going to say, if by June, July, things are looking bad for inflation, we might get aggressive. We might get aggressive. And that means 50%. Markets are going to go that immediately when it starts. It doesn't happen on the small time frames. I don't even know why you would want to trade this here and then buy, and then 5 minutes later you've been stopped out, because a human being talks like this, like in like 5 minutes, you say three things that contradict each other but make sense for the bigger picture. So I'm just saying, if he says in June, July, if he gives those dates, the next financial quarter, right, and he says, look, we might be looking to get a little bit more aggressive then in what you want to look out for, or rather, this then will start to make sense. Why next March already markets already priced in at 0.50 basis point? Because everybody's looking at inflation, but the Fed is looking at inflation and the impact of the war. Guys, I hope this was okay. I hope this helped you. I feel like this is extremely, I don't even think it's safe to sell here, but that's my humble opinion. I have seen Nasdaq sell off a broken supply during this war sentiment time. I don't know where it was, somewhere up there. Nasdaq did sell through and sell with a broken supply, so it's still a potential setup. But for the most part, I have no interest in this thing. If I go to my 15 minutes time frame, and then I can try and find where's the London session there. So markets opened here, markets based. There you go. It's simple, eh? This is intraday stuff. It's beautiful and simple. You can't tell me you missed it. You can tell me you missed it as a swing trader because you're not supposed to be looking at your charts all the time. But as an intraday trader, markets open at 9. You should be at your desk by 7, 2 hours before, by the way, preparing. When I was working on the floor at Allen Gray, my senior guys would show up at 8, and I'd have to have compiled reports so that by 8:15 we'll fill in orders before the markets open. I had to be at work by 6:30-ish in Cape Town, literally about 6:30 in the morning. And no, because the guy I was under at the time, he needed a full report, right? And it's kind of like you don't even get paid for that. Long story short, you need to be in front of your desk, not at 9 o'clock, but before 9 o'clock to see where price is going to turn. But if you're watching Nasdaq today and you've done my course, I say there's 100% guarantee, right? And I say it's going to last a year. I can even say it's going to last 10 years if you want. It's 100% guarantee on my course where all the rules that I've taught you, they're not working. You simply print me your statement, you show me the rules you apply and where money screwed you over. And if you're right that my rules are not working, you get your full fees back. But if you part of the intraday stuff that we do every day in the mornings, and I've taught you the importance of market opens at 9 a.m. You've been watching Nasdaq today. Well, you were unfortunately you were probably here. Well, I ran late anyway. So at 9:15, there was a red candle in the opening. You didn't care. At 9:30, there was another red candle. You went to go make yourself a cup of tea. By 10 o'clock, a quarter to 10, when we started, all of a sudden there was a bullish engulfing pattern here, there. This happened today. The entire time I have been talking to you, this happened today at the market opening. And then if you just followed a little bit of my module 1 and followed a little bit of my module 2, you'd have drawn a horizontal line and gone 13,600. Jeez, what a coincidence, right? I mean, 365 traders, you know what I'm talking about here, right? And you're done. All you're waiting for is you put a pending order there. Why? Because you don't want to just market execute. Because remember, if you market execute at quarter to 10, you are buying at the top of a bullish engulfing pattern, which is where retail traders buy. Retail traders are taught to wait for confirmations. You don't do that. You're taught to buy low. And I've told you many times, markets will come back. Markets will come back. Markets will come back. And by 10 o'clock, I'm assuming, let's see. Hurry up. There we go. Boom. There was a big red candle that triggered you. Where? Guys, the mathematical accuracy of my trading strategy is insane. Boom. Now you're in the money and you're trying to take profit just before a New York session. This is the markets today. Since the entire time I've been talking. Nasdaq has moved a couple of good points, a couple of healthy points. This is good money. It's still moving. By the time I see this, right, this is me now. This is how I'm not in this trade with you, but just so you know, I probably have had 2 positions here, depending on my capital and my leverage stuff, right? And trade number 1 out of broken even there, right? Trade number, that's trade 1, broken even for the swing, because I like to swing. Trade number 2, I'm here now, 15 minutes. Okay, 15 minutes is clean. I'm going to drop to 5 minutes. If it's an intraday, trade number 2, I've locked my stop loss right there. So I can't lose anymore and I'm making money. If something goes wrong, I'm hoping this 5-minute order block will hold. If not, I get stopped out. I've made about 50% of the move from the time I entered. Simple. And then I do it again tomorrow and the next day. Trading, the mechanics of trading should be boring. They are for me, because I know the rules. I just follow the rules. The life around trading is exciting. The information, the twists and the turns, I enjoy that kind of stuff. But in terms of mechanic robotic trading, this should be boring stuff. Oh, okay, here's an order block. Guys, shout out. Thank you so much. If you enjoyed this, if this helped you, please don't forget to like the video. I would thoroughly, honestly appreciate that. And yeah, have a good day. I will do my best to try and stream FOMC meeting today. You know, if that's something I'm free to do at 8 p.m. I am by myself this whole week on the trading floor, absolutely by myself. You know, everyone else is supporting a good friend of ours within the floor. So because of that, you know, I'm crazily, you know, a bit like I'm running like a mad person. I'm making my own tea. You know, no, that just sounds so snobbish. Never mind. Bye-bye. Thank you. Bye-bye. Appreciate you. Have a good day and good luck tonight, guys. Right. Protect your accounts. Don't do what I wouldn't do. God bless you all. Goodbye. Cheers, everybody.